let me start by telling you a bit about Counterpoint, and sort of who we are. Counterpoint is a commercial PACE provider. We have been in existence since 2014, and we have been actively sourcing and closing PACE assessments. Counterpoint has a partnership with Hannon Armstrong, and Hannon Armstrong is a publicly traded REIT that invests primarily in renewable energy and energy efficiency projects. So, and Hannon Armstrong is an equity owner of Counterpoint. So, you know, there was a recent New York Times article, and it had a very important statistic. It said that 38% of travelers would be willing to pay more for a travel service provider who demonstrates environmental responsibility. That's quite an important metric, and you know, from a personal perspective, I used to travel to San Francisco quite a bit, and California has been a leader in energy conservation and water conservation, and these sort of programs are very they're quite prevalent in California, where energy efficiency and water conservation have been a driving force. Generally, a little bit more about you know, green properties. Again, just the level of ambiance when you enter into a hotel that has green attributes. It is a more pleasant experience for the travelers, but generally, by greening your hotel, it improves in energy. It improves energy efficiency. It decreases your maintenance costs, and generally promotes. It's a good social promoter. Another important statistic is that the drive towards sustainability is primarily being driven by millennials, and millennials as a group represents the largest segment of the traveling population. It continues to grow. So again, you know, that has become quite the catalyst for the travel and services industry to move towards a more resilient and a greener environment. The hospitality industry in general, again, as I mentioned earlier, San Francisco, for example, because of the drought, the water conservation, the hospitality industry was at the forefront of embracing renewable green energy and energy efficiency. You know, 23 global hotel chains have they're global in nature, but primarily in the United States, they have adopted. They've moved more towards green energy and resiliency. Here's an example of a hotel chain that prominently displays on its website the net impact of green energy measures. And for example, again, this was another New York Times article. If you, for guests who stay at hotels, if they decline daily housekeeping services, the hotels compensate them with food vouchers or other sort of guest points. So again, the necessity for greening, again, it helps in water conservation, it helps in energy efficiency, but not only does it make the travelers feel good, but the hotels are compensating them through other royalty and reward programs. So let's get to, you know, how do you? We understand that greening is important. It's again not only because of the social impact. We realize it's important, but how do you pay for it? So let's talk about PACE. There are a number of options to finance greening projects. You know, one can choose equity, one can choose debt, or PACE. PACE was started out in 2007, 2008 timeframe after the financial crisis, and it started out in California because, again, because of the situation there, the government wanted to promote a mechanism for homeowners and property owners to finance energy efficiency upgrades to their properties. So they came up with a unique construct that involved a public-private partnership, in essence allowing property owners to finance these upgrades through their property taxes. So there are a number of constituents that are involved in the PACE process. It involves your local taxing authority. It involves a local economic infrastructure, a semi-government organization that facilitates the PACE process. It brings jobs to your local communities, and at the end of the day, it's the most beneficial to property owners who can finance energy efficiency upgrades through a cheaper cost of capital, and I'll get to that in a bit. Here is a list of some of the early, leaders who've accepted PACE, who've adopted PACE. They include prominent brands such as Hilton, Westin, Simon, Anheuser-Busch. And again, the list is far greater than what can be demonstrated here, but it's quite wide and it's quite deep. PACE financing is again, it's very unique from equity financing or debt financing, and I'm going to go through some of the major beneficial attributes of PACE. 100% of your energy efficiency or a renewable energy project can be financed through PACE. And depending on the property type, the amount of PACE as a function of the property value can differ, but for hotels, it's generally 20% of the assessed value. PACE has long-term fixed rates. It amortizes on a linear basis over the course of the PACE assessment that can range anywhere from 5 years to 30 years. And more importantly, if you finance an upgrade to your property, the PACE assessment, unlike a loan, it doesn't have to be prepaid. The PACE assessment is transferred to the buyer of the property, which is a unique attribute of PACE. Again, some points that are noteworthy is PACE, as I said, is an assessment. It is not a loan, so it does not show up on your balance sheet. An assessment is levied on the property every year for the tenor of the assessment. And PACE, as we mentioned earlier, has flexible financing, rate options, and term options. So, at the end of the day, the question is, when you finance any sort of energy efficiency upgrade, whether it be a green roof or whether it be a chiller or energy efficient windows or doors, how do you finance it? You can choose to use your own equity. Equity is a very expensive source of capital. The return thresholds for equity are much higher, generally 15 to 20%. And again, that equity could be used elsewhere to finance other more higher ROI projects. You could use mezzanine debt, which is slightly less expensive than equity. But again, the one thing about mezzanine debt is that it requires usually balloon payments at the end of the term. And the property owners has to factor that into their financial metrics. And PACE. PACE is a option that is the most efficient here. It not only allows a linear amortization schedule over the term of the loan, but it's the cheapest cost of capital when compared to equity and mezzanine financing. So in this example, just try to give you a perspective. In traditional commercial financing, the capital structure is comprised of equity, anywhere from 12 to 20%. There is a small mezzanine strip, and the vast majority of the capital structure is comprised of senior debt. And again, on a weighted average cost of capital basis, this ranges. what PACE allows you to do, allows a property owner to do, is replace the mezzanine component, which is which is the second most expensive part, because equity generally is the most expensive. It allows an owner to substitute the mezzanine debt with PACE. And again, the benefits of that are your weighted average cost of capital declines, and secondly, it's not a balloon payment. PACE payments generally go out over the term of the PACE assessment. So again, an important attribute. This is a similar construct, which is what we talked about. Is by eliminating the mezzanine, you can also reduce the equity component by increasing the PACE component of the capital structure. At the end of the day, essentially the weighted average cost of capital for your property will go down using PACE. PACE is, again, the construct for PACE is energy efficiency and water conservation. So within that, there's an endless list of things that can be financed using PACE, and there are 4 different types of industries that have primarily leveraged PACE. One is the hospitality industry, the multi-tenant commercial office industry, multifamilies, and new construction. Let's just sort of reference hotels, for example. Here is an example of a hotel in Los Angeles that was operationally not profitable, and what they did was they opted for a PACE financing of $7 billion over a 20-year period. With the PACE financing, they upgraded elevators, LED lighting, HVAC, again, anything that made operations more efficient. And the net result was the net operating income increased. The reason it increased is because energy costs declined. Again, electricity costs declined. There was general water and energy savings. So at the end of the day, PACE was a construct that was used for this particular property to make it profitable by increasing the NOI. Some other benefits of PACE, again, because of the nature of PACE, because it is an assessment, it doesn't have, there is no requirement for a balloon payment. You forego the need for, because it's not a loan, it doesn't show up on the balance sheet of the owner of the property. Unlike a loan, there are lots of other restrictions or covenants that are not applicable to PACE. However, PACE has its unique operating constructs as well. Again, to re-emphasize, PACE spans across a bunch of, it can finance any renewable energy or energy efficiency measure, including water conservation. So some examples include green roofs, common area retrofits, and in San Francisco, seismic retrofits is eligible for PACE. The rationale for that is because of the location of San Francisco, earthquakes are they're quite a common occurrence, and buildings or multifamilies that are not seismically strengthened, they are at risk of being condemned by the city. So the city approved a measure that allowed property owners to strengthen their properties by using PACE. And this has, again, been quite well received in the seismic community in San Francisco. Green roof, as I talked about, is another area extensively used in the hospitality industry. Again, you sort of eventually come back to the point: if I finance a very capital-intensive project, how do I pay for it? You have to allocate capital efficiently. Equity is generally the most expensive source of capital, so you have to create a construct where the return on your investment matches the cost of financing, and that's where PACE has been very useful. The other important attribute about PACE is some of the greening costs can be passed along to guests of the hotels. So, for example, in San Francisco, I know which all hotels do is they pass along a water conservation charge and an energy efficiency charge. Um, so that is an attribute of PACE that is not present in any other sort of financing. Again, going back to seismics, one of the things that the law in San Francisco allowed property owners to do is pass the cost of that entire PACE assessment to the tenants of the building. So that is, again, you can also do that with other financing mechanisms, but the statute specifically provides for this pass-through for PACE in seismics. Florida is another very important PACE jurisdiction because of the constant threat of hurricanes. The legislature has allowed homeowners to use PACE for wind resistance. That includes roofing, that includes windows, in addition to general energy efficiency measures that include solar and water conservation metrics. One unique thing about PACE is this issue of lender consent. Because PACE is an assessment, it is levied by a local tax jurisdiction. Mortgage lenders typically require the property owner to get consent from mortgage lenders. Generally, the larger banks, as PACE has become more prominent, they have agreed to provide lender consent, and there are a significant number of banks that allow property owners to use PACE as a financing metric. And again, this is taking a bit of time, but banks now realize the importance of PACE and the importance it has on the net operating income of the property. Just to provide the financial backdrop, by implementing energy efficiency measures, you have more free cash flow to service debt than you would have otherwise. And that's the rationale that has gotten banks to consent to PACE financing. And furthermore, at the end of the day, if your net operating income is higher, then it translates to a higher value for your property. I'm going to spend a few minutes on how PACE works in terms of the mechanics. Generally, once a PACE financing is completed, you as a property owner or a hotel owner will pay your PACE assessment with your property taxes. So the PACE assessment is levied by the county or your local jurisdiction. They will send you a bill that outlines your property taxes, but there will be a separate line item that will emphasize your PACE assessment. That PACE assessment is collected by the county and is deposited into a trust account, which in turn reimburses or redirects the cash to the PACE lender. A little bit about how the PACE process works at Counterpoint. Again, we are commercial underwriters, so once we have a project, or once you provide us with a project, we will evaluate the property, we will underwrite it, and we will be able to quickly give you an opinion on how much PACE you can put on your property. And once that process is complete, we go through an underwriting process that requires document collection, working with the contractor who will do your energy efficiency financing or whatever upgrade that you deem necessary and it fits under the PACE construct. So we work with all parties involved to make sure that we're all aligned and we sort of move expeditiously towards a closing process. In general, the whole process takes anywhere from 45 to 60 days. And and by the end of the process, we will allow a construction period of up to 24 months. So we will schedule a payment schedule for you that works with your contractor and that works for you to finish the project. Again, another summary of the payment schedule. As I said, at Counterpoint, we have the unique flexibility to work with you and your contractors to come up with the schedule that is timely and that works for all. Just as some, this is a map of where PACE is enabled in the country. Right now, there are 33 states, including the District of Columbia, that authorize commercial PACE programs. We are active in all of these states, and as PACE gets more prominence and it becomes more widely accepted as a part of the capital structure, we believe that the adoption of PACE will permeate throughout the country. Again, to summarize, one unique aspect of PACE, unlike debt, is that it allows for 100% financing. So this is, in addition to equity, apart from equity, this is the only construct that allows 100% financing of all of your project costs. It replaces mezzanine debt, which is generally more expensive, with a source of capital that is cheaper than mezzanine. It is non-recourse financing, there are no balloon payments, and it amortizes over a term of your choosing that can range anywhere from 5 years to 30 years, but is generally tied to the useful life of the upgrades that are being done. In most cases, PACE financing is cash flow positive because of the energy efficiency savings that are realized in year one. Solar, for example, there are tax benefits that are related to renewable energy that can be realized, and also generally in the hotel example that I discussed earlier, the net benefits of the PACE enhancements were more than enough to offset the payments of PACE. Because PACE enhances net operating income, that is a metric that's used to value real estate, commercial real estate in particular. PACE generally leads to enhanced property values. As discussed previously, it's off-balance sheet financing, and again, the most important part, which is the green attributes. It leads to it's good social responsibility, and at the same time, it doesn't. It's a great financing construct where it lowers the cost of capital. Happy to answer any questions. Thank you.
Thank you very much. We do have a few questions, and if you have additional questions, please type them in. The first one is, we actually have somebody that's developing a new property and wanted to know who they could contact to discuss that with. Would it be you? Would it be okay for them to reach out to you directly?
Yes, they can reach out to me. I have two of my colleagues here as well, Sal Tarcia and Lance Mold. Sal Tarcia, Sal handles principal transactions for Counterpoint, and he is very much involved in new construction. So if you send me an email, I'm more than happy to pass it along to him and put you in touch with Sal.
Perfect. The next question we got was, when I'm doing my renovations, how can I make sure I'm following energy efficiency guidelines?
Well, generally, there are Department of Energy guidelines. For example, if you are putting in solar, you get net savings in year one. But if there are other measures such as water conservation or LED lighting, there are Department of Energy guidelines on efficient equipment that they authorize. But if you get in touch with us, we're more than happy to direct you to the right place, and we're happy to work with you on determining if these are the right measures.
Okay. And the next question we had was, will the new tax law impact PACE?
Well, PACE is, as I said, PACE is it definitely impacts residential homeowners because with the new tax law, there is a limit on tax deductibility, but it does not impact commercial property owners.
Okay, perfect. Well, that seems to be all the questions that we have. So again, we want to thank you for providing this very informative webinar to our members. And we want to thank everyone that joined us today.